We have a great question here from a new subscriber who says that they've heard us talk a lot about implied volatility recently, as well as risk reversals in a video today for the pound. And they say that they are aware what implied volatility is and how to use it in the trading, but they're not familiar with risk reversals, and they just want some more detail on what it is and how they can use it in their analysis. Now, firstly, thanks for the question. And I know that you said you're already familiar with implied volatility, but just for the sake of the rest of the community, I'll just quickly explain what implied volatility is as well, because it is important to understand that first in the context of risk reversals. So let me open the chart that we looked at today, which was this one over here. The only thing that I've done extra is I've just added in the pound dollar exchange rate at the bottom. But what we can see here is the bottom two, the orange and the green, is basically just the 1 month and the 3 month implied volatility for the pound dollar. And the two lines above that is the 1 month and the 3 month 25 delta risk reversals. Now, starting with implied volatility, it sounds really fancy, when we say implied volatility, but to break it down really simply, the implied volatility for any asset, whether it's the pound dollar or the S&P or, oil prices, whatever, the implied volatility for any asset is simply the amount of uncertainty that the options market is pricing in for that particular asset during a specific time horizon. So for example, this one here in the orange is the 1 month implied volatility. So that means that this line resembles or reflects the amount of uncertainty that the options market is pricing in for the pound dollar in the next month, if that makes sense. So whether you are looking at 1 week or 1 month or 12-month implied volatility, you are essentially seeing what amount of uncertainty the market is placing on that particular asset for that particular time horizon. It's also important to remember that it's not set in stone. I mean, implied volatility fluctuates as the spot price fluctuates, as well as the perceived uncertainty increases or decreases for that particular asset. Now, as you know, there's usually an inverse relationship between volatility and price. So as volatility moves up, we normally see price goes down. As volatility moves down, we normally see price goes up. But that doesn't always mean that there is necessarily a lead lag relationship there, because implied volatility can change, like we just said, based on the spot price changes, based on how the uncertainty changes. But thinking of, implied volatility or volatility having an inverse correlation to price will suffice for this video as we get to the analysis part. So then taking a look at the risk reversal, which is the top two ones. What exactly is a risk reversal? Now, there is a difference between a risk reversal strategy, which means that you are basically buying a call and a similar delta put at the same time as a type of hedging strategy. But that's not what we're referring to here. What we are referring to as a risk reversal is basically the difference between a out-of-the-money call option and an out-of-the-money put option of the same delta. So in the example that we have on the chart here, we're basically looking at the 1 month risk reversal, which is the 25 delta risk reversal, which is basically the difference between the 25 delta call and the 25 delta put. So because we are looking at the difference between the volatility of a similar call and a similar put, we are essentially seeing what the balance of risks are between a big upside move in the currency pair or a big downside move in the currency pair. So remember that more calls in the market means that there's more of a bullish expectation, and more puts means that there's more of a bearish expectation. So when risk reversals are moving higher, when we see risk reversals are moving higher, it means that call options are getting more expensive than put options, which means that upside protection is getting more expensive for that particular asset. And if the risk reversal is moving lower, it means that put options are now becoming more expensive than the call options. And that means that there's more downside, or downside protection is getting more expensive when that happens. And that normally implies a move lower in price. So a very big and positive move to the upside in risk reversal shows that the options market is pricing in a higher probability that that particular asset or pair is going to move higher or continue moving higher. And where we see a very big and negative move to the downside in risk reversal, that implies that the options market is pricing in a higher probability that the pair moves lower, if that makes sense. Now, another way that you can look at this is by looking at something that we call a volatility smile. I'm not sure if you're familiar with that. If you do have access to Metastock Zenith, you can actually access their FX volatility app, which allows you to see the volatility smile. Now, the smile you'll see has the at the money options right in the middle. So that's basically at the spot price, the at the money price in the middle. And as the deltas decrease, you'll see from 45 to 40 all the way up to 10. As the deltas decrease, you're basically getting further away from the current spot price. And that obviously means there's more uncertainty about where price will be the further out you go away in time. And if the smile shifts more to the left, or skews more to the upside to the left, that usually means that there's more demand for the put side. And if it skews up to the right-hand side, it means that there's more demand for the call for call options, right? So whenever you see that skew, it shows you in which direction the market is implying from an options point of view, where they think the higher probability the market is going. So if we see, like we said in this example, if you see puts starting to see more demand as we go further out the curve, it means that there's more anticipation of downside than there's anticipation of upside. So going back to that chart, if you see your risk reversals are tilted to the downside, as we've been seeing over the last couple of sessions, you see, like we said, that volatility smile skewed to the upside. When you see that happens, it means that there is more demand for puts. So the puts are getting more expensive than the calls. And that means that downside protection is increasing, which means that from an option market point of view, they're thinking that price might be going lower. Now, if we bring that practically back to the pound dollar today, we know that the bias has been tilted to the upside for the pound for the past couple of weeks, as well as the past couple of months, as the markets have basically continued to price in a higher probability of a deal outcome versus a no deal outcome, which has seen a very sharp rise in risk reversals over the last couple of months, as one would expect. Now, where we stand right now, the market is arguably still bullish on the pound. I mean, if we just take a look at the price action, we're still bullish on the pound. The market hasn't changed that bullish bias right now. But what we have been seeing happening as we're moving closer and closer to the end of December, we've seen risk reversals continue to push lower, meaning that there's an increased demand in the options market for puts versus calls. And at the same time, we're also now starting to see a slight move to the upside in implied volatility as well. So what does that mean from a practical point of view? It means that, yes, the bias for the pound hasn't changed. It's still tilted to the upside. Like we said, as long as negotiations continue, talks continue, that bias should remain to the upside. But it does show that the market is getting more and more nervous right now as we head closer towards the end of December and we don't have a deal yet. And if the risk reversals continue pushing lower and implied volatility continues pushing higher, we could see much more volatile moves in the pound from positive and both negative news hitting the wires. As positions in both spot as well as option markets will need to basically either increase or unwound their positions depending on the actual outcome for that Brexit negotiations. And that means we should trade with a lot more caution here, even though the bias is tilted higher. The markets are getting a lot more nervous about the state of where the pound might be going next. So I do hope that helps with your question. And if there's any others, as usual, please don't hesitate to let us know.